90% of traders think their problem is strategy. They keep switching indicators, changing concepts, jumping from one model to another. But the real difference between losing traders and profitable traders is something completely different. In this video, I'm going to show you, step by step, how smart money actually moves the market, where the high probability sell is, where your stop should go, where your target should be, and what most traders consistently misunderstand. Make sure you watch this carefully. Let's start with the chart. The first thing we always analyze is market structure. Here we clearly see the market forming lower highs and lower lows. That tells us the overall structure is bearish. Then we get a bullish move that breaks the most recent internal structure. That is the first break of structure. After that, we see a second structural shift. However, this does not automatically mean the entire trend has reversed. Notice what happens next. Price pushes from the lows and rallies back up, almost into the same range we see in the first image. Now, this is where most traders get trapped. They see the bullish momentum and assume the trend has changed. But structurally, the overall market context is still bearish, so our bias should remain bearish. That means we are looking for sell opportunities, not buys. Now let's define a valid order block. For me, a high-quality order block must meet two conditions. 1, it must be responsible for a break or shift in structure. 2, before the impulsive move, it must have taken liquidity. If we look closely here, price first sweeps liquidity above this short-term high. After collecting that liquidity, we see a strong bearish displacement that creates the structural break. That is not random movement. That is engineered liquidity collection followed by distribution. So this zone becomes our valid order block, not just a random rectangle, but a zone backed by liquidity logic and structural shift. Next step, patience. We do not chase price. We wait for price to return to our predefined order block. As price trades back into the zone, we can refine our entry using lower timeframe confirmation. For example, an internal break of structure on the 1-minute or 5-minute chart, or the formation of a lower high inside the zone. Now, before entering, we define our exits. For the target, I'm using sell-side liquidity, the equal lows and resting liquidity below the market. That is where buy stops are sitting. So the trade plan becomes clear. Entry, sell after confirmation inside the order block. Stop loss, above the order block. Target, sell-side liquidity below. The trade aligns with the higher timeframe bias, liquidity narrative, and structural logic. And this brings us to the real difference between losing and profitable traders. A losing trader might see the exact same setup, but they enter too early, or they ignore confirmation, or they move their stop emotionally. A profitable trader executes the plan as defined. They predefine risk before entry. They accept the outcome before the trade even triggers. If the stop gets hit, they move on. If the target gets hit, they follow the same process again. Smart money is not just about identifying order blocks. It's about understanding structure, liquidity, timing, and executing the same model consistently. That's the edge.